Hello everyone, and welcome back to the channel where we dive deep into the fascinating world of hard-to-borrow stocks and potential short squeeze setups. Today, we're putting a specific company under the microscope, NCT Limited, trading under the ticker NCT. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's talk about NCT. NCT Limited operates in the industrial sector, specifically within marine shipping services globally, and it's also involved in pulp, paper, and paperboard processing. It's a relatively small player with a market cap of $34.01 million. Show chart, NCT recent performance. Looking at recent price action, NCT has shown some interesting momentum. Today it's a plus 1.14%, over the last 5 days it's gained plus 4.73%, and over the past 30 days, we've seen a plus 13.83% increase. Volume has also been active, with today's volume hitting 1,055,700 shares, which is 1.3 times its 30-day average volume of 795,013 shares. What is cost to borrow and why it matters? So, what does it mean for a stock to be hard to borrow, and why should you care? When a stock is hard to borrow, it simply means there's high demand from short sellers who want to bet against the stock, but limited supply of shares available to lend out. Brokers charge a fee for these borrowed shares, known as the cost to borrow, or CTB fee. This fee is an annualized percentage. If a stock is in very high demand to short, and supply is scarce, this fee can skyrocket, often exceeding 100%, and sometimes even reaching into the hundreds or thousands of percentage points, as we'll see with NCT. A high CTB indicates significant short interest and difficulty in establishing or maintaining short positions, which is crucial for squeeze potential. Why this stock is hard to borrow right now? Now, let's get specific with NCT Limited, NCT. This stock appeared on our hard-to-borrow screener with an eye-popping annualized cost-to-borrow fee of 677.5%. Highlights CTB number. That's an extremely high fee, signaling that it's very expensive for short sellers to hold their positions. While the exact shares currently available to borrow are unknown, NCT estimated float is exceptionally small at just 0.3 million shares. A small float means fewer shares are actively traded, making it easier for price movements to be magnified and for short sellers to find themselves in a tight spot if buying pressure emerges. Squeeze mechanics explained. So, how does a short squeeze work? Short sellers borrow shares and sell them, hoping to buy them back later at a lower price for a profit. But if the stock price starts to rise, especially for a stock like NCT with a tiny float, these short sellers begin to lose money. With a CTB of 677.5%, the cost of holding that losing position also becomes incredibly painful. This pressure can force them to cover their shorts, which means buying back shares in the open market to return them to the lender. This buying activity further pushes the stock price up, triggering more short covering, creating a cascading effect known as a short squeeze. However, it's critical to understand that high cost to borrow does not guarantee a squeeze. It can also signify that short sellers have very strong conviction that the stock price will eventually fall, and they are willing to pay a premium to maintain that bet. Dilution risk check. One crucial factor for any potential squeeze play is dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This typically lowers the value of existing shares and can completely offset or negate a short squeeze thesis, even if the cost to borrow is sky high, because new shares can provide liquidity for shorts to cover. For NCT, our check found no recent dilutive SEC filings such as -1s, -3s, or 424 BS in the last 90 days. This is generally a positive sign for a squeeze scenario, as it means the company hasn't recently flooded the market with new shares. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Given NCT 677.5% annualized cost to borrow and its tiny 0.3 million share float, it clearly meets the criteria for a hard-to-borrow stock. Our internal composite squeeze score for NCT sits at 42.5. While not the highest score we see, it's noteworthy, especially when combined with the recent positive price momentum and today's 1.3x relative volume. For traders watching NCT, key indicators would be continued upward price movement, increased volume, and any further reduction in the already scarce supply of borrowable shares. A significant jump in buying pressure could put serious strain on those short positions. So, into Cayman Limited, NCT presents a very interesting case study in hard-to-borrow space, driven by its exceptional CTB and low float. Whether this translates into a full-blown squeeze remains to be seen, but the conditions are certainly worth monitoring for those interested in these unique market dynamics. If you found this deep dive into NCT helpful, please hit that like button, subscribe for more unique stock analysis, and let us know in the comments what stocks you'd like us to analyze next.